Hello, and welcome to the first lecture, What is a cryptocurrency or crypto token? In this lecture, you will learn what makes a cryptocurrency, what is unique about cryptocurrencies, what properties do they have that make them exciting, and how are they different from traditional currencies. So what is a cryptocurrency? A cryptocurrency uses encryption to verify the transfer and ownership of digital coins across a network of computers. So what makes cryptocurrency so unique? Well, for starters, there's no central authority. Where in fiat or government-backed currency, the rules governing the supply, transmission, and distribution of value can be unclear, and in cryptocurrencies, all rules are transparent and part of a public record. Second, balances are often recorded and held on a massive global ledger called the blockchain. We'll go more in depth about what this means in Lecture 4 when we talk about Bitcoin. Third, balances are held entirely electronically with no physical counterpart, unlike paper money or gold. Fourth, cryptocurrencies have a total verifiable supply and price which can let you derive a market capitalization. This market capitalization represents the theoretical value of all tokens in existence. Throughout this course, you will begin to understand how to use the checklist to analyze any cryptocurrency. So why is cryptocurrency so exciting? Crypto is freely tradable and can be transferred anywhere in the world very quickly. There are no trusted parties, and unlike traditional banking systems, there's no clearinghouse or third party who can block or freeze transactions. It's extremely low cost and efficient to move value. Minor transaction fees are low cost and don't scale with the amounts, making cryptocurrencies very effective and efficient store of value. Crypto has been growing extremely quickly, which has put the investment spotlight on it. We'll talk more about why it is growing so quickly in the next lecture. So to summarize the comparison, fiat or government-backed currencies have a centralized authority, the rules are not set, supply can be manipulated, it is almost always inflationary, requires trusted intermediaries, but it is a widely accepted payment method, and there's a lot of infrastructure already built around fiat currencies for high transaction throughput. Cryptocurrencies have no centralized authority, rules are set and verifiable, supply cannot be manipulated. Some are inflationary, some are deflationary. Their trusted intermediaries are not required for transactions. It is not very widely accepted as payment compared to fiat, and blockchain scaling is still an area of research and development. So this is a chart from the Residence Group showing the buying power of a dollar over time. And as you can see, over time, it has greatly decreased, and this is largely due to inflation. We'll be giving you a checklist in this course that you can use to analyze any cryptocurrency you want. By the end of the course, you'll be able to understand all the items in the checklist and will be equipped with the tools to navigate the space. So this concludes the first lecture, What is a cryptocurrency or crypto token? In the next lecture, we'll talk a little bit more about why cryptocurrency is growing so much. Thanks, and we hope you found this lecture helpful. Hello, and welcome to your second lecture, Why Now? Why Cryptocurrencies? In this lecture, we'll talk a little bit more about why cryptocurrencies have been growing so much. In this lecture, you will learn how much is the cryptocurrency space growing? What is driving the growth behind these cryptocurrencies? Why are people so excited about blockchain? And what sorts of projects are utilizing this technology? So cryptocurrencies are growing extremely rapidly, and while everyone knows about Bitcoin, there are many other tokens that have been growing extremely rapidly. Here's a chart of some of the big winners over the last year. But what exactly is driving all this growth? Well, cryptocurrencies are aiming to be better money. They aim to replace existing financial instruments and tackle a massive market. Furthermore, they've also been gaining major media attention, with all the millions being made and hacked. And cryptocurrencies have all the unique benefits that we covered in the last lecture. There's no central authority, no intermediaries, and very low cost. But most of all, blockchain technology is being used to create more than just digital tokens. Blockchain has the power to revolutionize computing as we know it. So what does it mean to replace money? In the top left, we can see the total market size of cryptocurrencies as of June 2017. If cryptocurrencies were to replace money, we would see a similar market capitalization to that of gold or spendable money. Furthermore, if cryptocurrencies can replace financial instruments, market caps the size of stock markets or all money may be within reach. Blockchain technology has more applications, though, than just creating better money. We will go into a few examples of what blockchain is being used for today. The first example is Siacoin. Siacoin is a decentralized private file storage system. It uses the blockchain to organize a network of storage devices. The token is used to drive the service. The token can be used to spend Siacoin to store files, or you can receive Siacoin for sharing your compute or storage space. Siacoin is promising technology in the world of fog computing, which uses blockchain technology to organize networks of computers for computational tasks. The next example is Augur. Augur is creating blockchain-based prediction markets. Using Augur, you can create prediction markets for any event, such as presidential elections, stock prices, or even the weather, and have people trade against the outcome. This is very powerful because it allows anyone to gain insights and forecasts into the future, and furthermore could be used for price discovery and giving intangible events value. Augur is promising technology in the decentralized prediction market. Finally, we have Steem. Steem is a blockchain-based social media platform that rewards users for interacting with the platform. Steem uses blockchain for content discovery. Steem rewards users who provide value in interacting with the platform. Steem rewards you if you consistently post high-quality content, or who consistently upvote high-quality posts, and rewards can be in the form of coins or influence. Steem is promising technology in the decentralized community-oriented social media platform. We are making more courses that use the fundamentals from the rest of this course and apply them to analyzing more tokens in the market if you enjoy these sorts of coin spotlights. Since cryptocurrency is so open, it is easy for anyone to participate, and it is very easy to have high transparency and gain insight into coins that are highly liquid, meaning that it's easy to buy and sell. Furthermore, there's been rapid growth which makes these coins highly attractive. For the first time, the average person can participate in all these revolutionary ideas. In short, blockchain technology is revolutionizing many industries all at once, showing a promising new technology on the rise. But you have to be very careful in this space. There are many scammers and hackers, and small mistakes can be very costly. It's an extremely volatile market and and all the technology is very early stage. Never invest anything that you can't afford to lose. Thanks, and this concludes the second lecture, Why Now? Why Cryptocurrencies? Thank you, and we hope we found this lecture helpful. Hello, and welcome to your third lecture, How to Get Started with Cryptocurrencies. In this lecture, you will learn what is needed to hold and send Bitcoin, what is needed to hold and send Ethereum, how do you create and use an Ethereum and Bitcoin wallet, and how do you turn Bitcoin into Ethereum. If you're familiar with how to do all of this already, please feel free to skip this lecture. The first thing you need to do is create a Bitcoin wallet. This is very important if you want to have full control over your funds. A simple wallet that will manage your keys with a login is wallet.btc.com. For a wallet that runs on your computer and lets you manage your own keys, consider using Electrum. The wallet syncs to your computer, but you don't have to sync the entire blockchain. We will talk more about what syncing the blockchain and transactions mean on the next lecture. In both cases, keep your private key safe, which is either the PDF from btc.com or the wallet file in Electrum, since these will be required to recover your wallet if you ever lose it. Never share your private key with anyone if you want to manage your own keys. Here's what the wallet should look like for both Electrum and btc.com. Clicking Receive will usually give you the public wallet address on whatever application you're using, which is where the funds should be sent in order for you to take ownership. Then to send funds, click Send, enter the public wallet address of where you want to send, and the amount and the wallet should be able to handle the transaction. Now to take your first step into the crypto market, you have to acquire Bitcoin, which typically happens through fiat currency. We have a blog post here which will be linked in the additional resources document available to you, which details many of the different methods of buying Bitcoin. There are lots of ways to buy, so if you want to explore your options, that document will be helpful. Using the wallet that you created in the last step, you can send BTC to yourself to buy from your personal wallet. Alternatively, you can opt to keep your funds with a third party if you believe that they are trustworthy. Once you have Bitcoin, you can begin to exchange and buy other currencies. Now we're going to go through the process of turning some of your Bitcoin into Ethereum. The first thing you have to do is create an Ethereum wallet. This can be done easily through myetherwallet.com. Double check that the web address you are using is in fact myetherwallet.com and not something else. Then enter the password and don't forget it. Next, download the key store to your computer. This file is the private key and can be used to restore the wallet on other platforms, and is also used to interact with myetherwallet.com. Be sure not to lose this key and keep it very secure. You will also need your password in order to open it up. Now let's open up your wallet on myetherwallet.com. Go to the Send Ether and Tokens tab, then upload and unlock your wallet. Once you open it up, you should be able to see your public address on the right side. Now, go to shapeshift.io and select BTC to ETH. Shapeshift lets you quickly and securely convert funds from one currency to another. Now that you have Bitcoin and Ethereum in a wallet, you can use it to turn your funds from Bitcoin into Ether. Precise takes a little longer but is more accurate. On Shapeshift, select the amount of BTC you want to convert into Ethereum. Use your Bitcoin wallet in case the trade doesn't go through and they have to refund you. Use the Ethereum wallet that you just created for the destination address. After you deposit it, it will take some time to finish, but then it will convert your BTC to Ether and send it to your address. Congratulations! You have just completed your first cryptocurrency trade. If that was a lot of information all at once, don't worry. We'll be talking more about how everything works in the next lectures. Here's a slide with some additional resources and reading that you may find helpful. All resources will also be available separately as well. So this concludes the third lecture, how to get started with cryptocurrencies. In the next lecture, we'll dig more into how Bitcoin works, what makes it tick, what gives it value, and how digital currencies operate in general, which will help you understand how to interact with cryptocurrencies. Thanks, and we hope you found this lecture helpful. Hello, and welcome to your fourth lecture, What is Bitcoin? In this lecture, you will learn, what is Bitcoin? What is the blockchain? How do transactions work? And how does mining work? We won't be going into any code in this lecture, but we'll be digging a lot into the concepts in really good detail. This lecture is a little bit longer than some of the others, but by the end, you'll be very familiar with Bitcoin. So what is Bitcoin? Bitcoin is the first and most popular cryptocurrency. It was founded by the anonymous Satoshi Nakamoto in 2009, and since then has launched a lot of innovation in blockchain technology, which underpins its network. So what is the blockchain? The Bitcoin blockchain is a massive ledger of transactions. All transactions on the Bitcoin network get recorded on the chain. The blockchain has blocks which get created at certain intervals, and each block contains some data. Blockchains are append only, which means that they only get larger over time as new blocks get added. As of July 2017, the full Bitcoin blockchain was about 126 gigabytes. There are a number of implications of the Bitcoin blockchain. First, since every transaction gets recorded on chain with no encryption, transactions are transparent. Every person who runs a full Bitcoin node has a copy of every transaction. This allows anyone to independently verify any transaction. Block explorers like blockchain.info allow you to view blockchain data without downloading the entire chain. Every transaction on chain has a unique ID which can be searched and referenced. Furthermore, since you can view every transaction, you can also see the balance and past transaction history of any address. So how does a transaction work? This is what a transaction looks like at a high level on the Bitcoin blockchain. There are some inputs and some outputs, and you can see a single input go to multiple outputs, or you can have multiple inputs go to a single output. This is a visual representation of the transaction, and the first shows a single input with multiple outputs, and the second shows the multiple inputs with a single output. Bitcoin works using these inputs and outputs. When you receive Bitcoin, you're receiving an input to your address. When you send Bitcoin, you're using an output to your address to send an input to another address. Transactions send unspent outputs as inputs to another address. Your balance in your wallet is a sum of all unspent outputs to your address. To send a transaction, you use your wallet's private key to sign a transaction with an output and an amount. Signed transactions can only send the exact amount to the address specified and nothing else. This is what keeps the network secure, since you never need to expose your private key. Wallet software handles all the transaction signing for you and only broadcasts signed transactions. So you can give signed transactions to anyone, and signed transactions are what are stored on the blockchain. So where does mining come into play with all this? Well, mining is the process by which transactions get added to the blockchain. Mining also ensures that transactions are valid and that nobody is creating a fraudulent chain through the proof of work. We'll talk more about what this means. Miners verify transactions, bundle transactions into blocks, then solve the proof of work. The miner who solves a proof of work creates and issues the next valid block to the network. We'll talk more about what proof of work is in the next slide. After solving the proof of work, the miner gets an unspent output for themselves as a reward. Recall that unspent outputs are the equivalent of coins on the network. The mining process ensures that nobody is trying to spend an invalid output. In other words, that they actually have the inputs required to create the outputs. Miners can run a lot of checks on transactions to ensure they are valid, and this link has a full list of everything that miners check in case you're interested. So the proof of work is a simple yet powerful concept based on the idea that you have to prove that work was done, which gives the Bitcoin network security. Proof of work uses a one-way hash function, and a one-way hash function has a property that given a certain question, it always produces the same answer, but given only the answer, it is impossible to know what the question is. Here's a visual representation of it. So in our example, we have an input. So you first give a hash function some kind of input, which could be the string dog. You feed that string into the specified hash function, which in this case is SHA-256, which is what the Bitcoin network uses to secure it. And that string gets turned into an output. That output is always the same if you give the function the same input. In other words, if you give the function dog, it will always produce the string 0EB1, etc. Given that output string, you cannot tell that the string dog was inputted. Using the properties of a one-way hash function, the proof of work is the process by which miners prove that they did work. Miners ask questions using this function extremely quickly, trying to get a result from the function that meets certain parameters. For example, perhaps only outputs where the first 7 digits or zeros are accepted by the network as a valid hash. This is why, when a new block is created, you know a lot of computational work was put into it. So, taking the example of 7 leading zeros, if you find an input which creates that hash, you will have solved the puzzle. Furthermore, the question or input that you give the function has to include the previous block's answer, which creates the blockchain. So if you want to reverse a transaction on the network that happened in the past, you have to undo all the blocks that came after that transaction, which means that you'll have more computational power. You have to have more computational power than the entire network combined. So that was a lot of information all at once. So we'll go through a visualization of the same process to better understand it. Here we have 2 blocks that have been mined and their hashes. Note that these are real hashes from the Bitcoin network from blocks 1 and 2, and that everything in these examples are as accurate as possible. Miners are currently searching for the 3rd block. Now we see someone has found the hash of the 3rd block that fits the network parameters. As their proof of work, they provide that nonce value. Someone could verify that their proof is valid by executing the SHA-256 function themselves. If the network consensus is that the block is valid, or in other words that a majority of the hash rate decides that that block is valid, the miners will begin searching for a block number 4 using the hash of block number 3. Miners cannot start searching for block number 4 until block number 3 is found. If block number 3 is rejected for whatever reasons, then miners will continue mining on block number 2's hash until a valid block comes along. So what is more likely, however, than an invalid block is two competing chains with different valid blocks. Perhaps some miners are still looking for block number 3 when they detect the longer chain, which is already searching for block number 5. If block number 3 was found on an alternate chain, then it'll be orphaned as miners abandon the alternate chain for the main chain. The orphaned block could have been valid, but was not included since there was a different block number 3 that took its place. The alternate chain dies off and the miners move to the main chain. Mining of some sort is essential for every blockchain-based currency. Mining confirms transactions and allows value to be transferred. Mining secures the network, ensuring no malicious parties attack the network. Mining also creates the blockchain, which serves as a repository of truth and universal ledger of events on the network. Mining underpins the trustless consensus that allows Bitcoin and many other digital currencies to function. And here's a short summary of all that what mining enables on the Bitcoin network. And we made it to the end. We went very in-depth in this lecture, but it will serve as an extremely useful starting point for analyzing coins and understanding the space. Many people in the space still do not understand at a fundamental level how Bitcoin works. Simply knowing the information in this lecture puts you ahead of most people in the space. This concludes our 4th lecture, What is Bitcoin? Hello, and welcome to your 5th lecture, The Economics of Bitcoin. In this lecture, you will learn what gives Bitcoin value. What is supply and emission, and why does it matter? What is market capitalization and liquidity? And what are some of the important statistics to know about Bitcoin? Some of the numbers in this lecture may be out of date, but the economic principles are timeless. The numbers are as of July 2017. So why does Bitcoin have value? Well, value is derived from the trust that someone else also values it. In other words, if you use Bitcoin as payment, there's an inherent trust that someone else will also accept Bitcoin. There's this shared acceptance of value, which gives Bitcoin value. There's also an intrinsic rarity and fixed supply. And if there is infinite Bitcoin, nobody would value it since there's always someone willing to sell it cheaper. So it's basically, Bitcoin only has value because everyone thinks it has value. It may seem strange, but you actually experience this every day in daily economic activity. Recall that fiat is government-issued currency. Fiat has trust in the governing body that issues the currency and trust that others will also accept that currency and that the currency has value. Cryptocurrencies have no trusted issuing party, but also has the same trust that others will accept that the currency has value. The existing economic system runs on fiat currency, but fiat has the same intrinsic value that Bitcoin does. In other words, you can't eat dollars or Bitcoin, but both can be exchanged for food. So if something has a value, how do you determine what the fair price is? This question gets answered by economics, and it's all about supply and demand. If the price of Bitcoin is dependent on how many people want to buy and how many people want to sell, then you can calculate what the price of Bitcoin should be. On the right side, you can see a graph of the supply of Bitcoin over time. If you had a similar graph for demand over time, then you could predict the price. Unfortunately, predicting demand is nearly impossible. The supply of Bitcoin increases over time until a maximum of 21 million coins. Gold operates in a very similar fashion in that there is a maximum fixed supply not determined by anyone. Bitcoin also has an emission rate and market cap. A certain predefined number of Bitcoin get created in each block as a reward to miners. Currently, the reward is 12.5 Bitcoin per block. And the reward halves every 4 years in an event known as the halvening. There's a cap of 21 million coins ever in that Bitcoin can ever exist. And market capitalization can be calculated using the price of a coin and the supply of a coin. The market cap gives a quick estimated valuation of a token, which is very useful for estimating what the current demand for a token is. You may start to note that some of these concepts can be applied generically, and that's on purpose because we are trying to generate a framework to better understand the crypto market as a whole. So these concepts can also be applied to fiat as well. Fiat also has a supply. Narrow money is usually what is referred to as being the supply of money. We have a graph here from Trading Economics showing the supply of US dollars over time. The supply of the US dollar is determined by the Federal Reserve, who is trying to ensure economic stability. As of July 2017, the total supply of dollars was roughly 38 trillion. The purpose of these parallels is to show that the economic principles that govern Bitcoin are no different than the economic principles that govern everyday economic activity. Market depth and liquidity are very important concepts to understand in openly traded markets. Liquidity is the amount of value available in the market. In other words, the amount of value you could extract either on the buy side by buying up what is being offered, or on the sell side by selling the product on the market. Highly liquid markets are easy to buy and sell in and out of. The market depth is the amount of open orders there are on a market. Having healthy market depth in a highly liquid market is important for an asset to maintain value. A market crash occurs when there's too much on the sell side and not enough on the buy side. Liquidity and depth are important for any asset. Bitcoin is a highly liquid asset with a large daily trading volume. This means Bitcoin is easily exchanged into many fiat currencies. So next we're going to go over a few fast facts that also play a part in governing Bitcoin's price. Some of these factors are the cap supply, in that there's a fixed amount of Bitcoin, and the current supply, which is around 16.49 million. The market cap, which can be calculated by the current price times the current supply. The block time, which is how often blocks come, which is also tied into the emission rate, which is how quickly Bitcoins are emitted into the market. And these are all things that you should look at when analyzing crypto tokens. Coins have a variety of specifications which influence their value. There's a great deal of fundamental analysis that can be done to help determine the market potential of a coin. And we're going to be going over this framework in depth in Lecture 7. So this concludes this lecture on the economics of Bitcoin. Thanks, and we hope you found this lecture helpful. Hello, and welcome to your 6th lecture, Improving on Bitcoin. And in this lecture, we're going to be talking all about Ethereum. So in this lecture, you're going to learn, what is Ethereum? What does Ethereum do? What are smart contracts? And what are some of the different problems that Ethereum solves? As of August 2017, Ethereum was the second largest cryptocurrency by market cap. It has consistently showed market dominance as a smart contracts platform. So what exactly is Ethereum? Think of it sort of like Bitcoin that you can program. It has a vision of being a worldwide distributed supercomputer that anyone can use. Ethereum is an open source, public distributed computing platform. Ethereum features a smart contract scripting language. And the scripting language is Turing complete, which means that it can do all the same computations as any other computer. The smart contracts run in what is called the Ethereum virtual machine. The machine is made up of all the miners who support the network. The network provides a cryptocurrency token called Ether. And the network also features gas used to allocate resources on the network. Ether can be spent on computational tasks or on transaction fees through the gas functionality. Ether is a functional token which gives the user access to the Ethereum virtual machine, which is different from Bitcoin, which is just a currency. So what exactly is a smart contract? We're going to demonstrate using the example smart contract called the soda machine smart contract. This contract is very simple. Deposit 0.01 ETH, and you get a soda. The code for the contract may look like the following. Bear in mind that the code is not Solidity, which is what the Ethereum network runs on, but the idea is the same. With the soda machine, there's an implicit contract. You trust that the soda machine will give you a soda when you put in coins. Using an Ethereum soda machine, there's no trust because you know that you will get the soda. So with Ethereum, there's no trust or centralized machine. Your contract gets executed exactly as it's written, which also means that you have to be extremely careful to write your contract correctly, since bugs can cost you a lot of money. Smart contracts enable a whole new class of applications called dApps, or decentralized applications. dApps can't be stopped by any third party and are 100% transparent. Gas that is consumed to run dApps gets paid back to the miners, giving miners a financial incentive to help support and secure the network, just like Bitcoin. So what are a few applications that are possible with smart contracts? Well, the most common application of the Ethereum smart contract system is the ERC20 token standard. Anyone can create and issue their own token using the ERC20 smart contract. Decentralized exchanges are also possible, where there's no trusted third party that has to hold funds. Decentralized governance is also possible. You can have a secure voting and governance structure that is completely transparent. You can create ownership and financial structures on the blockchain that run on smart contracts. This essentially lets you create blockchain-based companies. Smart contracts have many applications in many sectors that still haven't been fully researched or explored, and the door is wide open to innovation. Here's some fast facts about Ethereum. This data is as of August 2017, but we can use the same economic analysis that we did on Bitcoin on Ethereum. In Ethereum, there's no hard cap supply. There's a fixed issuance per block, which is currently 5 Ethereum, but there isn't a hard upper limit like there is in Bitcoin. The current supply is around 93.88 million. There's significantly more Ether than Bitcoin, which means that if Ether commands the same valuation or market cap that Bitcoin does, its price will be lower. The block time is much, much lower in Ethereum, with each block coming in at roughly every 20 seconds. The algorithm that Ethereum runs on is ETH-hash. This algorithm is different from SHA-256 and doesn't require specialized hardware to be efficiently mined. The emission rate is fixed in perpetuity, but some planned hard forks may decrease the emission rate and slow down inflation. Despite being based on the ideas of Bitcoin, Ethereum has a vastly different specification and functionality, making the economic analysis much different. Ethereum, however, solves many of Bitcoin's problems. Ethereum can handle 2 to 2.5 times as many transactions per second as Bitcoin can. Bitcoin is estimated to be around 7 to 10 transactions per second, where Ethereum is around 15 to 20 transactions per second. Ethereum has a full scripting language and use cases outside of being a store of value in a currency. Faster block times also means that you can get faster confirmations of payment quicker. Ethereum's 20 seconds is much faster than the 10 minutes it takes for one confirmation in Bitcoin. Ethereum hasn't reached the same level of adoption that Bitcoin has, and its brand is not as widely recognized. Bitcoin has a first mover advantage, which has contributed to its higher valuation. But that being said, Ethereum derives its value much differently from Bitcoin. Ether has more value than simply in the fact that everyone believes in its value. Ether has a functional value on the Ethereum network. If you want to run a smart contract, you have to use Ether, and miners are willing to accept Ether to run smart contracts. So this concludes this lecture on improving on Bitcoin. In the next lecture, we'll talk more about Ethereum and how it stacks up against Bitcoin, and how you can use general analysis techniques to analyze any token. Thanks, and we hope you found this lecture helpful. Hello, and welcome to your 7th lecture, the checklist for analyzing crypto. In this lecture, we're going to be comparing Bitcoin and Ethereum. So in this lecture, you will learn how do you use a checklist to analyzing crypto? What are some of the different things that you should research? How can we apply the concepts from this course in our analysis? And how can we compare Bitcoin and Ethereum? Again, all the numbers are as of August 2017, and these numbers may or may not be out of date depending on the markets and time of viewing. So the checklist to analyzing crypto is a primary focus of this lecture. The checklist helps you structure analysis, especially when looking at a new token. This checklist is provided to you as a resource in this course. We highly encourage you to follow along with the checklist since we'll be performing the analysis of Bitcoin versus Ethereum using this checklist. The checklist will go through supply, market cap, trading volume, liquidity, mining, algorithm, technical underpinnings, usefulness, development team, community, and governance. We're going to go through each one of these factors in this lecture to compare Bitcoin and Ethereum. This lecture will be a bit long, but it'll be very detailed, and by the end you will understand how to use the checklist properly. So the first section of this lecture will be objective analysis on coin statistics. All these facts are publicly available about a token. You should be able to gather all the facts for yourself first before moving on to subjective analysis. So the first item is supply. The first step is always to analyze the supply. Ultimately, a token's price is determined by supply and demand, and since supply is public, you should always research it. So here we have the Bitcoin supply, which is capped at 21 million. The current supply is around 16.5 million. Emission is around 50 Bitcoin per block, which halves every 4 years. So the emission currently is around 12.5 Bitcoin per block. And another thing that is more of a subjective factor in this is fair distribution. Fair distribution meaning were the coins distributed fairly, or did a single actor gain a lot of them? Mostly yes in Bitcoin, but an unknown actor, Satoshi, who created the network, has 1 million tokens. Now we analyze Ethereum supply. Ethereum does not have a capped supply. The current supply is around 93.88 million. And the emission is currently 5 Ether per block. And fair distribution, you could argue that it had a fair distribution because there was a token sale for initial distribution. Now the second item is market cap. And in this, we're going to also go through trading volume and liquidity. Market cap gives you a decent estimated valuation. Trading volumes let you estimate the buy and sell interest. Liquidity lets you determine how easy it is to buy and sell. You will have to look at the order books on exchanges to determine the exact liquidity, but it's still something worth researching. So now here's the Bitcoin market cap, trading volume, current price, and volume versus market cap ratio, which is something interesting to look at for liquidity. So market cap 60.3 billion, trading volumes around 2 billion every 24 hours, current price around 3,654, and the volume or versus market cap ratio is about 1 over 30, which means about 1 over 30 of the total market cap is trading every day. Now you can look at the same statistics for Ethereum. You can see the market cap is much lower, 29 billion. Trading volume is about half that of Bitcoin, 1 billion. The current price is $309, and the volume versus market cap ratio is different. It's a little bit better than Bitcoin in that there's more of it trading, but only slightly. Next, you want to look at the mining algorithm. Check what the mining algorithm is for a coin. Is it proof of work, proof of stake, or something else? What is the block time or confirmation time? This is a measure of how long payments take. Is there ASIC hardware resistant? ASIC stands for Application Specific Integrated Circuit. ASIC hardware is specialized equipment designed only to mine a coin. This creates higher barriers to entry for mining. So in the Bitcoin mining algorithm, the algorithm is SHA-256. Block time is every 10 minutes, which means that payments can sometimes take a while if you have to wait for confirmations. And there's no planned algorithm changes, mining algorithm changes, other than SegWit plus block size, which changes a little bit of the block structure and block size increases. And there is no ASIC resistance, which means that SHA-256 has specialized hardware and is not efficient to mine on ordinary hardware due to the amount of ASIC hardware out there. Ethereum, on the other hand, also uses proof of work, uses the Ethash algorithm, and the block time is every 20 seconds, which means that payments are much faster. There's no planned algorithm changes other than possible future proof of work and lowered emission. And there is ASIC resistance because of the possibility of transitioning to proof of stake has prevented the development of ASIC hardware, and it is still efficient to mine on ordinary consumer hardware. So that ends the first section on objective analysis, and the second section is all about subjective analysis. We'll be doing a variety of subjective coin quality analysis on Bitcoin and Ethereum. Subjective analysis is very important because it is hard to know a token's future based simply on the facts alone. A coin could have very similar factual figures to another coin, but be far less attractive from a subjective analysis point of view. So the first item in this section is technological underpinnings. Evaluate the technology behind this coin. How strong is the technology? Are there any bugs, network issues, vulnerabilities? This includes documented and theoretical vulnerabilities. How good is the code base? So, since this is largely subjective, this section will have mostly paragraphs analyzing this. So, Bitcoin was largely written by a single individual or groups of individuals that go by the name of Satoshi Nakamoto. Bitcoin proved to the world that blockchain-based currencies were not only viable but inevitable, and that the protocol has gone through a few upgrades through Bitcoin improvement proposals, but has largely remained the same due to the strong underpinnings of the technology. The technology is a little bit out of date compared to other recent projects, but is still rock solid and reliable. Ethereum was the first universal smart contracts platform, featuring a huge deal of technical innovation that has changed the blockchain space. Ethereum has been notorious for the huge fortunes that have been made, but also the fortunes lost through various smart contract hacks, most notably the DAO, where over 150 million of ETH were drained, leading to the Ethereum and Ethereum Classic split. Ethereum, however, has been extremely resilient and has shown its ability to grow and evolve in the face of everything that has happened. So the second item in the subjective analysis is usefulness. Does the token actually solve a problem? Does the token do something better than something else? This could be better than some other token or better than some centralized system. Is there a real demand for what the token does? And then at the end of the day, if the token isn't useful and or there's no demand for it, then it won't grow. Bitcoin, as we've discussed in previous lectures, is looking to improve money. It's decentralized, a store of value, easy to transmit, and doesn't require the use of trusted parties to transfer. Before Bitcoin, the only equivalent was gold or equivalent commodities. Bitcoin's continued growth has shown that there is a massive demand for a currency that is not controlled by any central party. Bitcoin has also demonstrated the viability of the entire blockchain space and has been adopted by many merchants for payments. Ethereum also solves a lot of the problems that Bitcoin solves with the improvements that we discussed in the previous lecture. Ethereum offers a lot more than just a currency, however, and also offers the ability to run decentralized applications. Ethereum is not only better than Bitcoin, but also offers additional functionality not offered within the Bitcoin ecosystem. Ethereum's massive use case has been through issuing tokens and creating decentralized applications. Ethereum has garnered massive demand, which is only growing. Next, you want to look at the development team. Does the token have a dedicated development team? How strong are their credentials? Commit history? How are they getting funded? And both Bitcoin and Ethereum are massively decentralized with worldwide teams working on them. So this isn't as relevant, but it's mostly more relevant to smaller projects. Bitcoin, anyone can work on Bitcoin. There's lots of development going on, and some of the top minds in computer science are working on Bitcoin. Again, commit history is mostly only relevant to smaller projects, and companies such as Blockstream encourage the development of Bitcoin Core, as well as additional infrastructure for the ecosystem. Bitcoin is also open source and anyone can contribute. So in Ethereum, there is a dedicated team with the Ethereum Foundation. The credentials of them, they're all blockchain veterans with Ethereum as their track record. The commit history is mostly only relevant to smaller projects, and Ethereum Foundation was funded through the initial token offering that Ethereum had, and Ether has grown considerably in value, adding to their funding. Additionally, the Ethereum Enterprise Alliance is showing significant commercial interest in Ethereum. So the fourth item is community. Is there a passionate and supportive community behind the project? Is the community active in improving the token, or are they just bystanders? Are they helpful and friendly to newcomers? Now, these questions, again, are mostly only relevant to smaller projects. Community support, however, is how many projects get off the ground. Without the support of the community early on, Ethereum wouldn't exist like it is today. But since it isn't as relevant to Bitcoin and Ethereum, we're not going to be covering it in depth here. Item 5 is governance. How is the project run? Is it open source? Is there a company or venture capital firm or foundation backing it? What sort of voting mechanisms are there? What sort of community sway is there? And there's a lot of different governance structures out there, and many of them have their different pros and cons. Bitcoin governance, a very famous quote from Satoshi is 1 CPU, 1 vote. Hash power votes on upgrades. And Bitcoin is open source. There's no official backing, but anyone can submit improvement proposals and anyone can fork the coin. It's just a matter of support and how much people support the initiatives. Ethereum has a development and release roadmap. It is also open source. There's backing from the Ethereum Foundation and also recently the Enterprise Alliance. It's largely developer driven, but the community has shown that it has a voice through the Ethereum Classic split. As always do your own research. All investment decisions are your own, and never invest more than you're willing to lose. Don't consider anything in this lecture or course to be official financial advice, and it is always important to do your own due diligence and research into projects. But what you can use is you can use this checklist as a guide for analyzing your own tokens and doing your own research, and you'll find that you will often learn things much better that way. So this concludes this lecture on using the checklist for analyzing crypto to compare Bitcoin and Ethereum. Thanks, and we hope you found this lecture helpful. Hello, and welcome to your 8th and final lecture, A Whole New World of Coins. In this lecture, you will learn why the checklist is useful for comparing tokens, some high-level descriptions of other coins, some things that makes each coin or token unique, and how you can go about learning more about these coins. Here at Bitcoins, we're working on building more courses to help newer users learn about the new economy and all the different tokens that are out there. In future courses, we may go into more detail on each coin than we do in this lecture, if we see the demand for that sort of content. So in the last lecture, we looked at comparing Bitcoin and Ethereum. Similar analysis can be applied to any token. You can use the checklist to do extensive analysis on any crypto token. In this lecture, we'll be doing a one-slide analysis on a variety of tokens so you can get an idea of what is out there. But in future courses, we may do full analysis of tokens using the checklist. But now you have all the knowledge required to do the analysis yourself, now that we've gone through the full analysis in the previous lecture. So the first coin that we're going to go over is Ripple. Ripple is the largest company-founded token. Unlike other coins which strive to create an equal distribution, no pre-mine, Ripple's entire 100 billion coin supply was created and issued to the founders and Ripple Labs. 20% is owned by the founders, and 80% is distributed to Ripple Labs, intended to be used to fund operations. Boasting an impressive 93.6 million raised, along with billions of dollars worth of Ripple, Ripple is set to be the king of fintech or financial tech companies. Ripple has a slightly different consensus protocol that is being targeted at specifically making bank settlements very fast, cheap, and easy. Using a system of liquidity providers, which are essentially local markets, banks can buy and sell Ripple to move value around rapidly while at the same time stabilizing the price of Ripple. Ripple doesn't actually operate on a blockchain, but rather on what is called the Ripple Consensus Ledger, which relies on trusted validator nodes. As of August 2017, Ripple has the third largest market cap with over 6 billion circulating. The next coin is Litecoin. Litecoin is the silver to Bitcoin's gold. Litecoin seeks to solve many of the technical issues that plague the Bitcoin network and intends to be an alternate store of value to Bitcoin. Litecoin aims to be complementary to Bitcoin and has a community intent on improving the consensus algorithm. Litecoin uses Script, a memory-bound algorithm that was designed to be ASIC resistant. However, ASIC has been created once it became economically viable when Litecoin grew in value. Furthermore, Litecoin seeks to activate network upgrades such as segregated witness, or SegWit, which other coins have adopted in order to increase network throughput and solve scaling issues. Litecoin also chooses to have a lower block time for faster confirmations, but that comes at a cost of having a higher number of orphan blocks. Litecoin has 4 times as much everything of Bitcoin, 4 times faster blocks, 4 times larger supply, and 4 times larger emission. Dash, or originally called Darknet, was originally later rebranded to dissociate with the negative image. Dash, however, has had a troubled past, emerging from during a time of scam altcoins, which were pumped and subsequently dumped, leading to the term pump and dump being added to the cryptocurrency vernacular. With what is being called the insta-mine of 1.9 million coins in the first 2 days of release, attributed to an incorrect difficulty calculation, there has been some contention around fair distribution. Dash uses a different form of governance utilizing masternodes, which create a form of a 2-tiered network. Masternodes control the governance, voting on proposals, computing private send, and instant send, while miners do the normal consensus through proof of work. Using a treasury system, Dash is able to fund development of the network, and the model has been very successful thus far. A notable fork of Dash, PivX, seeks to solve the troubled beginnings of Dash. Dash was also the first masternode-based currency, which demonstrated the viability of the masternode system. So now, the most notable and contentious hard fork in the cryptocurrency history produced Ethereum Classic. When a smart contract system went awry and many millions of dollars worth of Ethereum that the community had pooled for development had been attacked due to a vulnerability in the contract, the community had a choice to make: either alter the blockchain to return the funds to the original owners or leave it be. A majority voted to give the funds back to the investors, but a vocal minority did not and exercised their right to vote with their mining power. The Ethereum network split, and now we have Ethereum and Ethereum Classic. Ethereum Classic is identical to Ethereum, except with a different development schedule and a different community and a different blockchain. Ethereum Classic reminded everyone in the blockchain community that if you disagree with a development decision, you always can vote against it with your hash rate. Monero, translating to coin in Esperanto, is the only coin that can truly claim to be transparent, completely private. A transaction is private by utilizing a 3-layer system. Senders utilize ring signatures to hide their addresses, ring CT hides the amount, and stealth addresses hide the receiver. In the pipeline is Kovri, which is similar to Tor, and would even hide the node and sending IP addresses. With this level of paranoia in transactions, it's no surprise that Monero has been adopted by many parts of the darknet for illegal transactions after multiple busts of illegal Bitcoin transactions that were thought to be anonymous. Another notable feature of Monero is its scalability using dynamic block sizes. With no set block size, it immediately sidesteps many of the scaling issues plaguing the Bitcoin network today. It also uses a memory-bound proof of work, which is used to provide ASIC resistance. The Monero network is also the only network that undergoes 2 scheduled hard forks every year consistently with no competing chains. Bitcoin isn't truly private, but Monero actually is. Again, as always, do your own research. All investment decisions are your own. Never invest more than you're willing to lose. And the crypto space is very volatile, and it is important to always do your own research and due diligence into projects. This concludes the final lecture in this course. Now that you've completed this course, you know all about what a cryptocurrency is, how Bitcoin and Ethereum work, and how to analyze tokens in the space. Congratulations on completing this course, and we hope you found this course helpful. Thank you. Hello, and welcome to this course, your simple guide to Bitcoin, altcoins, and cryptocurrencies. Bitcoins is offering this course to make the cryptocurrency market less daunting to everyone. Our mission at Bitcoins is to simplify the market and make it understandable to everyone, driving the adoption of blockchain technology. This course will consist of 8 lectures covering all the basics that you need to know about the cryptocurrency world. By the end of this course, you will understand what cryptocurrencies are, how they work, why they have value, and how to use them. Furthermore, you will receive a checklist so that you can analyze any other crypto token in the world. In the first lecture, we will talk about what a cryptocurrency is and define what it is. We will be answering questions such as, what are the properties of cryptocurrencies? How are they different from traditional currencies? In the second lecture, we will talk about why cryptocurrencies are booming right now and why they are so valuable. We will be answering questions such as, why is there so much value being created? What is the technology behind all this value? What is so special about all these cryptocurrencies? In the third lecture, we will talk about how you can get started using cryptocurrencies and some do's and don'ts about interacting with them. We will be answering questions such as, how do I get started buying some? What do I need to know? How do I create a wallet and keep it secure? In the fourth lecture, we will talk all about Bitcoin and how it works. Bitcoin is important to understand because it developed all the ideas that launched the cryptocurrency revolution. We will be answering questions such as, what is a blockchain? What is mining? What is proof of work? In the fifth lecture, we will talk about the economics of Bitcoin and what drives its value. Once you understand the economics behind Bitcoin, you can begin to understand what drives value in other tokens. We'll be answering questions such as, what makes Bitcoin valuable? How do standard economic rules still apply? In the sixth lecture, we'll talk all about Ethereum and how it solved many of the problems that Bitcoin has. We'll be answering questions such as, what are some of the problems Bitcoin faces and how does Ethereum solve them? What makes Ethereum unique? In the seventh lecture, using all the knowledge that you've gained up to this point, we will talk about how you can analyze any cryptocurrency using the one-page checklist. You'll be able to look at any token and analyze its value in the market. We'll be answering questions such as, how to analyze crypto token? How do Bitcoin and Ethereum stack up? In the eighth and final lecture, we will talk briefly about what else is out there and how you can learn more. We'll also plan on releasing more courses that will cover in-depth analysis of more tokens using the framework developed in this course. We'll be answering questions such as, what else is out there? How are they different from Bitcoin and Ethereum? And where can I learn more?